Coming up in today's show, stocks start the month of August off on a soft note, JP Morgan says a new record high is inevitable, more big earnings results today, and Fitch downgrades the credit rating of the United States. Hey, what's up everybody? Welcome back to the Click Capital Daily Show. My name's Jared. I'm going to run you through all the most important news, data and charts from the markets today. And it was a bit of a soft start to the month of August, with a bit of bearish breadth across the board and only just a few pockets of green out there. And the stock market is close to all-time highs. The S&P 500 Total Return Index is only about 2% lower than its all-time close and has pretty much erased all of the bear market that we saw last year. And that's why we've got banks like JP Morgan saying a new record high is all but inevitable. They said a technical correction seems unlikely given the huge amount of money waiting on the sideline. And there's momentum in the economy and corporate earnings, which could see the S&P 500 hit 5,000 for the first time this year. But apparently it's not just cooling inflation, improving corporate earnings and AI. Some are now saying the fear of missing out is now ruling the stock market, and we've seen a key number of bears flip from bearish to bullish, including Morgan Stanley's top strategist Mike Wilson, who has been a famous bear this year, has even admitted we were wrong and has told his clients now that stocks are in a pivot rally. So we know we've got a lot of momentum in the short term in the stock market, there's no doubt about that. But US stocks are expensive by just about any measure, but some think they could keep rising anyway. We've now got a forward price to earnings ratio in the S&P 500 at just under 20, which is a bit above the 10-year average of 17.4. We've also got equity risk premium down to 20-year lows, and history shows us on data going back to 1991 that when stocks are valued north of 20 on a forward price to earnings basis, the annualized returns over the following decade tend to shrink to less than 5%. And we can also see that in S&P 500 earnings yield minus the 2-year government treasury bond yield, and that's down to a negative 1.12%. So in other words, short-dated government bonds are giving you more than 100 basis points of yield over the earnings yield of S&P 500 stocks. And not only is that the lowest it's been in the last couple of years, it's also the lowest it's been in over 10 years. And you'd have to go back to the early 2000s, late 90s, to find a time when bonds were yielding a lot more than stocks are now. We've got a couple of key earnings out today, including chipmaker AMD, who reported second quarter net income of 2 cents a share compared with 27 cents a share a year ago. Second quarter revenue fell to 5.3 billion from 6.5 billion a year ago. However, that weak year-over-year growth doesn't seem to bother the market at all, up almost 4% after hours as I speak. We also had Uber come out and report their first ever quarterly operating profit, with free cash flow coming in over $1 billion. However, they did disappoint a little bit on revenue, and the market seems to have not liked that, down over 5% today. And so just as I was making this video, we've just had news hit the wires that credit rating agency Fitch has cut the United States long-term foreign currency issuer default rating from AAA to AA+. They'd already placed the country's rating on negative watch in May, citing the debt ceiling fight, and they've said the repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management. They said in their view there's been a steady deterioration in the standards of governance over the last 20 years, including fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 25. And the market is selling off a bit here on the back of this news. Got the S&P 500 down 0.43% after hours as I speak. This is a look at the 5-minute chart. So it looks like we're probably going to gap down lower tomorrow. But the real question is this going to turn into a bigger pullback? Because the last time this happened back in August 2011, when Standard & Poor's did the same thing, downgraded America's debt from AAA to AA+, the S&P 500 ended up having a quick 20% correction over the next 2 months. And so it looks like the US government's spending habits of the last decade may be finally starting to bite in the perceived risk of them to pay it back. They have taken the national debt from 16 trillion up to 32 trillion, doubling it in the last 10 years, and with no signs of that trend stopping either. And this is on top of the news we got out yesterday of the US Treasury increasing its borrowing estimate for the third quarter to just over 1 trillion. So by the time we hit Christmas, this is likely to be over 32 trillion in debt that taxpayers will eventually have to pay back with their labor thanks to the spending binge current day politicians have been on. And so getting inflation down and those rates down and keeping the economy growing and keeping tax receipts coming in is very important now, because if the economy were to go into a recession over the next year or so, tax receipts will decrease. And if we still have high inflation, the cost of paying back debt will be high, and that could make things even more shaky. Over to economic data today, we've got a few PMIs coming in from across the globe, showing manufacturing is still contracting in a recession around the world, and including in the States, where we saw manufacturing employment coming in a lot weaker than expected at 44.4, and the ISM manufacturing PMI coming in a little weaker as well. Fed Fund futures still assigning an 18% chance that the Fed will hike rates later next month. Fear and greed index still elevated. Bit of a quiet day in the options market, just over 34 million contracts traded, with the majority still being calls. Dark pool traders still not showing much interest in the market here. Same with corporate insiders, only registering 30 purchases yesterday versus 117 sales. And so just looking at the government 10-year bond yield, back in August 2011, last time the states got a big credit downgrade, yields actually fell quite dramatically, starting the month at 275 and finishing the month at 175. However, we did push up a bit higher today, above 4%. And generally speaking, when a credit rating agency downgrades the debt of a company or country, that should give lenders less faith that the borrower will pay back their loan and there's more risk. Therefore, they should demand a higher yield in compensation for that risk, which in turn would cause bond prices to go down. And we did see that in long-dated Treasury ETF TLT today. Lost a key support zone here and closed below it just above $98 per unit. And that was a level we've bounced 3 times before, and we could be coming back down to these low 90s. And that news is spooking the stock market a little bit as I speak. S&P 500 currently down 0.4%. We've got the Nasdaq down over 0.5%, and same with small caps as well. So we'll just have to see how that plays out tomorrow. Looks like we're going to gap down, and we'll see whether we get that big pullback like we got back in August 2011, or if it just turns out to be another nothing burger, buy the dip, market shrugs it off, doesn't care, and the VIX continues to trade under 14. We've got short-term breadth continuing to pull back now to 62% of stocks above their 20-day average. Stocks making new highs as well, pulling back. Growth first defensive stocks still trading well, and we've got high-yield bonds just losing their 50-day VWAP. Dollar index is trading well, now back above its 50-day VWAP, and that should put further pressure on the stock market as well with a strong dollar. Bitcoin dipped below $29,000 a coin today. A little bit of softness in commodities. Gold's getting a little bit of a bid here on the back of that credit downgrade. Crude continuing to walk the line higher. And looking through stock sectors, mostly red out there today. With the AI ETF bots losing its 50-day VWAP, and even the defensive sectors, healthcare, staples, and utilities continuing to trade a bit weak. BlackRock continuing to pull back after we got new CEO Larry Fink sold more stock back here. JP Morgan continuing to consolidate a little bit. And the big ones on Friday later this week will be earnings out of Apple, still on this tight parabolic uptrend, and Amazon as well coming out with earnings on Friday. Microsoft continuing to consolidate underneath its 50. Google continuing to defend its earnings gap. NVDA still hovering near all-time highs, and Tesla looks to be putting in a bearish flag formation here. There's meme stock Tupperware continuing to have a ripping rally up 26% today, and they're coming out with earnings tomorrow. I would expect a big correction in this soon, and a bit mixed across the meme space. Still a bit of volatility in the sector. With Coinbase pulling back, they're coming out with earnings in 2 days. Continuing strength in Carvana. Same with Nikola on the back of that surprise order from JB Hunt. We also got earnings out today from Tinder operator Match Group, coming in with a slight beat on earnings and revenue. Market's liking that, up 10% after hours. And the regional banks continue to have a little bit of a pullback here today, along with a bit of softness in the big guys. Okay, so that wraps it up for today. The big news was rating agencies Fitch downgrading the United States debt. Kind of wasn't that hard to see it coming. They had put them on notice, the whole debt ceiling debacle, which seems to go on every couple of years. Politicians trying to fool us all with their parody-named Fiscal Responsibility Act, and they keep just blowing the budget out. At some point, the chickens are going to have to come home to roost, and we'll see what the resulting price action is in the bond market and stock market tomorrow, and see whether this is a cause for a bit of a pullback or correction, or whether the market just shrugs it off as a nothing burger. So tomorrow could be interesting, and make sure you come back to Click Capital a few hours after market close tomorrow, and we'll see what we've found. Until then, take care. Cheers.